Before the crisis, our primary goal was to ensure the safety and soundness of individual financial institutions. A key shortcoming of that approach was that we did not focus sufficiently on shared vulnerabilities across firms or the systemic consequences of the distress or failure of the largest, most complex firms. In the fall of 2008, the failure or near failure of several of these firms, many of which we did not supervise at the time, sparked a panic that engulfed the financial system and much of the economy. Today, we aim to regulate and supervise financial firms in a manner that promotes the stability of the financial system as a whole. This has led to a comprehensive change in our oversight of large financial institutions. As my written testimony describes in more detail, we have introduced a series of requirements for the largest and most complex banking organizations that reduce the risk to the system and our economy that could result from their failure or distress. In addition, we now supervise financial institutions on a more coordinated, forward-looking basis. Our reforms reduce the probability that large financial institutions will fail by requiring those institutions to make themselves more resilient to stress. However, we recognize we cannot eliminate the possibility of a large institution's failure. Therefore, a second aim of our post-crisis reforms has been to limit the systemic damage that would result if a large financial institution were to fail. Our new regulatory and supervisory approaches are aimed at helping ensure these firms remain strong. While more work remains to be done, I hope you will take away from my testimony just how much has changed. Our supervisory approach is more comprehensive and forward-looking, while also tailored to fit the level of oversight to the scope of the institution and the risks it poses. And the Federal Reserve is committed to remaining vigilant as a regulator and supervisor of the financial institutions that serve our economy.